First, I want to welcome everybody to the Open Enrollment, which is with me, Arthur Bush. I know a lot of people are familiar with me, but my name's Arthur Bush, CEO of Vita Financial. Me and Steven started the firm, or got into the business 10 years ago. And we've been growing and developing and everything since because of y'all's support. So we want to make sure that we put on these types of workshops and educational materials to pass down information as best as we can. So the first thing, what is open enrollment? Annual opportunity to review, time to adjust coverage for changing needs, limitations outside of open enrollment, employer government programs, impact on healthcare costs, and impact and importance for financial planning. So we use open enrollment. You guys, if you've been with us for a while, you might have seen the most recent email, or will be seeing an email over the next couple of weeks that contains some open enrollment materials. You can always go in and schedule the link directly, and we can get some time one-on-one. It's the perfect time for us to have an annual review, to have discussions about changes that have been going on, not only with your personal situation, but also, excuse me, projections of changes that are going on, even in the legislative environment. Adjusting needs or coverage for changing needs is a very big hot topic because of something like inflation. For example, cost of goods and cost of services have gone up. You've also seen your cost of living go up, and your incomes in some instances have gone up too. And your insurance portfolios need to reflect that. Also, your contributions to your 401ks, deferred compensation plans, and everything like that. Limitations outside of open enrollment, specifically for insurance, is one of the things that I'll go into a little bit more detail later, is the type of benefits that you have with your employer typically will only give you certain benefits that may not cover what the total gap is, what the total need is. So during our opportunity for annual reviews, we'll absolutely have that discussion of what we can expand upon. Our employer and government programs, a lot of people don't realize this, but a lot of your government or your benefits, are actually governed by something called ERISA. There's ERISA plans, and they have to provide the same benefits across the entire company, which might not necessarily align with what your specific needs are. And because of that, again, it's good to have a discussion about what your specific needs, so we can figure out a way to make sure that the benefits match you best. Our impact on our healthcare costs, insurance premiums. If you guys have been employed for 20 plus years, you know that insurance premiums have even been a hot topic. We've seen increases or decreases over some years, and that's something that's becoming an even hotter topic as we start to roll into Medicare, get into the retirement conversation. And then with financial planning, the obvious there, one of the things that I like to say in the financial planning principles, 100% of financial plans depend on two things: you being alive and you being able to earn income. And both of those can be supported by your employer benefits. So we want to make sure that we have the discussion to make sure that we can provide assistance as best as possible and ensure your financial planning needs are met. And with that, I'll hand over to Stephen.
Yeah. And open enrollment is a perfect time for you to evaluate the retirement savings, just really your savings strategy overall. It's a good time to kind of look at, just because most of the time it's near the end of the year. Some companies may, differ there, but most of the time it's around the time where you're going to want to be looking at, how much income do they make all year? What's the gross? What have I put aside in different places based on the deferral amounts? And I'll touch on that on the inside of on the slide. But the main kind of way we think about it is there are retirement accounts that you own and you sponsor, and there are retirement accounts that your employer sponsors. And during open enrollment, you are, working through the options available that your employer has for you, whether it be a 401k plan, whether it be LTIP, which just stands for long-term incentive plans, deferred compensation. All of those, types of accounts, retirements, and savings options are available to you depending on if your employer offers them. And open enrollment is typically the time where you're making important elections, such as with deferred compensation plans. Those types of accounts require you to elect a distribution schedule because there's certain rules around them. And this is the time that you would be making some of those decisions. So whenever you're making those decisions, the first thing we want to think about is, am I saving the assets on the inside of this account pre-tax, or am I saving it post-tax? Now, accounts that you defer your taxes on, and all these things, by the way, we consider them qualified because they qualify for preferential tax treatment. But these accounts, you're saving money in pre-tax, you remove it from your taxable income this year, so you don't have to pay income taxes on it now, but you will pay income taxes on it when you take it out. Post-tax, or otherwise known as Roth, or in some special circumstances after tax, applies to money that you pay the taxes on income tax now and save in that bucket. You defer taxes on the growth, but that money is income tax free when you pull it later. The importance of determining whether you want to save it pre-tax or whether you want to save it, after tax using Roth or something of that nature, is critically important, and it depends on when you plan to distribute money, overlaid with what the tax environment may be at that time. If you think that income tax rates are going to be much, much higher in the future than they are today, then ideally you probably would want to save money in a Roth or post-tax fashion, because you don't have the pending tax liabilities that you would if you saved it pre-tax. Vice versa, if we think tax rates are going to be lower, or maybe, in the same realm, 30, 40 years, whenever your time horizon is, you may want to pay pre-tax, defer the income taxes on it, and pull it later, because the environment, is lower, and you may think your net taxes paid by deferring them till distribution is going to be lower. So just identifying and choosing kind of the what tax exposure you want to have on the assets is critical. That comes first, and then you make choices relative to what type of account it is. So there's two types of retirement kind of ways to structure plans. There's a defined benefit plan and a defined contribution plan. A defined contribution plan is what most people are familiar with, whether it be a 401k, 403b, 457 plan. Your employer sets up an account that you are putting money in, but they also go ahead and define the contribution that they are going to place in that plan, whether it be a match, whether it be safe harbor, or something of that nature. A defined benefit plan is a pension plan, profit sharing, things of that nature, where the employer is determining what they're going to give you as a benefit. A lot of times it's based on tenure, age, sometimes classification within the company. So all types of factors that the company has control over designing that on. But those are the two types of plans that exist. So defined benefit plan oftentimes can be your PSUs, performance stock units, which Arthur, alluded to earlier, which is stock options, grants, those things. And that would be an LTIP. Or again, profit sharing, stuff like that. Executive compensation packages, all that's kind of wrapped up in some of the things I was just talking about, but your stock awards, your stock grants, your stock units, and your stock options are all kind of different. Grants is like the overarching, and the tax treatment of units versus awards versus options is also different, based on each one of those things can be. So just super important that while you navigate open enrollment, not only do you do some really good thought towards what can I save, what taxes do I want to expose, but you should also work with a tax professional as part of your end of year planning. Work with a tax professional in evaluating the compensation that I did earn this year through my LTIP or through deferred comp or any of those things. What did that do for me? What does that do for me when I file? Like things like that. It's a good time to, think about.
Just a small logistical note real quick, as well. If anybody has any questions, you can always drop your questions in the chat box, or you can always let us know, reach out to us directly. We can answer your questions during this and live, or we can answer your questions after the fact. So All things HSAs and PSAs. Now, HSAs, I know most people are familiar with, health savings accounts. PSAs are the things that I think are relatively new that a lot of people are not too familiar with. Personalized savings accounts is what those are called. You also might see something called an LSA, which is a lifestyle savings account. Now, HSAs and HSAs actually have a little bit of a hybrid between the qualified accounts, like what Stephen's referring to, and then even some of your health insurance plans. Health savings accounts do allow tax deductibility on contributions. And whenever you use them for qualified expenses, you do not have to pay tax liability on the qualified expense as well. Now, that does change if you use that on something that's not qualified. Now, the interesting thing with HSAs, I've also heard of them referred to as healthcare IRAs. I wouldn't necessarily call them that because by definition, that's not what they are. But the nuance of them is post age 65, why people call them this is post age 65, you do have the ability to use those for any expenses. So what people use them as often is an extension of their 401k. If we know we've hit our 401k match to include the catch-up contributions if you're above the age of 50, a lot of times people will make additional contributions into the HSA to either cover their healthcare costs at retirement, or we can use to supplement some of our costs later. Now, the interesting part is during retirement, if it's used for healthcare, you also do benefit from the no taxable distributions. Now, with the PSA, the personalized savings account or the lifestyle savings account is a little bit different, where that's more used for lifestyle expenses and it's employer funded. With PSAs or with lifestyle accounts, you guys are probably familiar with HSAs. Every year you have a balance that will continue to roll over. If you make $3,000 of contributions and it gets invested next year, it's $4,000, and then you can make an additional $3,000. Now you're at $7,000. PSAs are not like that. You have to use them in the year that it's granted. There is no real tax benefits to PSAs because they're employer funded, but you can use them for your lifestyle expenses. So think of it as like if you work from home often, you can use it for an ergonomic chair. You can use it for some of your work from home experiences. You can use it for your mental health care, stuff like that. Anything that you need for your specific lifestyle related to your employer, PSAs or LSAs, that's exactly what they're used for. I mentioned with that flexibility and portability, PSAs are a little bit more flexible in terms of usage because HSAs you have to use for healthcare, but HSAs are portable, PSAs are not. That's an important delineation there. In terms of eligibility, for HSAs, you have to be inside what's called a high deductible healthcare plan in order to make your contributions. And then PSAs are employer funded. So it's dependent on if your employer provides them or not. I'll ask if there are any questions about this specific point, any thoughts, anything that somebody has, because these are usually hot ticket items for employees.
While they're formulating, Arthur, I'll if there's any that come in, I will I do want to add, and it used to be more common than they are today, but FSAs, so like flexible spending accounts, limited purpose FSAs, which allow you to do just dental and vision, and then dependent care FSAs, dependent care flexible spending accounts, allowed you to pay for summer camps or things like that for dependents, or I think it's children under the age of 13 or something like that. Those accounts have also undergone quite a bit of evolution over the last few years, but they're not as common these days because you can't roll over. I think the balance, you can only roll over maybe like $500 or something like that. It's a fairly low limit. But what we are always telling people to check out, and this is just a shameless plug, hsastore.com or fsastore.com is a resource that I have always used just to get a good glimpse at what qualified expenses may be. And then speaking of qualified expenses, there is also a pretty good benefit to evaluating what your doctor is prescribing you, and speaking to them if needed about a letter of medical necessity, or some of those things. If you have healthcare expenses that are not commonly considered qualified expenses that an HSA or an FSA may normally qualify for, sometimes you can kind of get a doctor's note. And then again, I use those websites just to kind of look at what we can spend money on every year. I find that to be really helpful.
One last point before we move to the next is with contribution limits. Contribution limits apply to HSAs. They are means tested, so they could increase or do increase, technically could decrease every year. Right now for individuals is $4,150 and for families is $8,300 with $1,000 catch-up contributions to people age 55 and above. So contribution limits, because you qualify for preferential tax treatment, you get the tax deferral and the tax deductibility. Anytime something like that is available, there will also be a contribution limit. And with HSAs, that's what they are, just to make sure that I make the point. But as a note, like I mentioned, for retirement planning purposes, is one way to think of it is if you're a family, that could be an additional $8,300 you could add on top of your other saving strategies.
So understanding healthcare options is quite difficult these days, to be honest with you. There's been tons of changes mounting for years. Affordable Healthcare or Affordable Care Act, sorry, definitely had a lot of changes kind of to the field. We are healthcare. Well, we are health insurance licensed, but I would not hold myself out as a health insurance professional. My recommendation always is this: when it comes to open enrollment, you need to get your, I believe it's called summary of benefit or explanation of benefits, like whatever the summary benefit plan description kind of things are, Arthur, that we use for the retirement side. For healthcare, they make kind of comparisons of different coverages. So you should get the resources on the plans that your employer offers, and then go online and look for a health insurance comparison tool. There's a bunch of them out there, but they allow you to actually enter in like different types of coverage, whether you're using a high deductible health plan, which we're going to talk a little bit more about, just kind of the right type of plan in a moment. But whether you're using a high deductible health plan, whether you're using something that has your HMO just exclusive, in network type of setup, it's super important that you evaluate what your deductibles are, which there's a bunch of definitions on here. I'm just going to kind of talk through them. Of your deductible is how much you need to pay before your insurance kicks in, starts covering. Sometimes you have a co-insurance on plan or co-pay that has you kind of pay a piece of the medical bill in order to have it done. And again, a lot of people, if you've been health insured, you've probably dealt with most of these things. Out of pocket is a term that we kind of want to stay away from. It's the out of pocket maximum. If you're spending that much on your out of pocket care throughout the year, you've probably had something catastrophic or something of that nature. So just means that we're meeting maximum out of pocket costs each year. And then premiums is exactly what most people are familiar with, is what you pay for it. The in-network versus outwork or out-network component does play a factor in your level of care, does play a factor in who's available to you, what different types of prescriptions you'll receive, all types of things. So again, I'll talk a little bit more about that in just a moment on the next slide. And then Medicaid and Medicare, which are also just super common healthcare terminologies or definitions that are basically government programs that help provide health benefits. Medicare is 65 plus or individuals living with certain disabilities, and then Medicaid is to for those in need. So choosing the right plan. There's really kind of four main ones out there these days that are really worth understanding. There's point of service and a PPO, POS and a PPO, which are kind of similar. They both allow you to choose in-network and out-network, out-of-network, but there's increased costs And if you go to an out-of-network doctor, the HMO, health maintenance organization, is just a lot more restrictive. You can really only go to the doctors in network. There is no out-of-network care. And then I probably should have mentioned the difference between the POS and the PPO is whether or not you need a referral from your primary doctor. Here's the beauty of it. Everything that I'm talking about right now, I know that it's impossible to keep up with. That's kind of the point. There's so much information related to healthcare. The best thing you can do is go to your open enrollment resources, pull down the benefits guides for every single plan, and go through them line by line and figure out what is the difference and what is my personal healthcare situation, because ultimately that is going to be the determining factor of what's right for you. And then last but not least, if I am kind of pondering this question, I'm trying to figure out what's the right plan for me. Questions I'm going to want to ask myself are, what am I out of pocket cost? Am I healthy? If I'm not healthy, do I expect large surgeries or issues that I need to handle next year? Because again, open enrollment, you're planning benefits for the next year's enrollment is what you're doing, or you're a new employee, life change, those things. But am I healthy? What can I expect there? What medical expenses are the rest of my dependents, expected to have? My kids, my spouse, am I going to need to worry about anything related to them? Because remember, that also plays a factor there on the policy. Also, with all the changes that are happening, I can honestly say changes to health insurance plans are probably where I've seen the most confusion over the last few years. Arthur, you may agree, may not agree, where because of just the rapid changes in the private market, different companies pulling out of different states, different employers making different deals with different providers, all types of things. We see health insurance kind of get churned over a lot, through providers. And the issue is that sometimes, again, like I described with the HMO, there are no out-of-network doctors. So what happens if the doctor you were using on the previous plan that you had with the same employer, you didn't change employers? What happens if your doctor isn't on that network? Right? What happens if we have to have medical provider changes? All types of things kind of need to be considered. But again, it's just a thought exercise that you have to do, and it's that important every year. The last thing that I'd speak to is FSAs, HSAs. Are they worthwhile? Because that's a big question to ask, because high deductible health plans, ADHPs, they're only available. Or your HSA is only available for a high deductible health plan. It's the only time that you can utilize those types of accounts. So what the savings mechanisms that you have available to you that Arthur was talking about earlier, those things are dependent upon the type of plan you use as well. So it's a little bit of a math game on how much money am I deferring, what am I saving in these different places, these buckets, what's the tax benefit of the HSA or some of those other accounts, and does the premium offset for what I'm expected to pay out of pocket? So just, I know I just said a lot. It's a big math problem. Seriously, I'd recommend that you very simply put, like, search for health insurance tool calculator or calculator tool, and you'll probably find something that's helpful. Arthur, I'm good to go. Sorry.
I wanted to confirm something that you were saying. I know this oftentimes seems like with 401k contributions, deferred comp, and some of these retirement planning tools, that they change frequently, but it's really just the contributions that change. The confusing thing with health insurance is it's the definitions that change. Anytime definitions change, there's a lot of variance there in what things mean or don't mean, things that are included or things that are specifically excluded. So the confusion among health insurance is commonplace, and we can absolutely have a discussion to make sure that we're picking the correct types of coverages. Other employer offered insurance options. So some of the popular ones: life insurance, disability insurance, accidental death and dismemberment, critical illness, accident insurance, hospital indemnity, and pet insurance. With life insurance and disability insurance, those are probably the two most common that we see, because they're typically provided in lumps. Now, with life insurance, there are minimum benefits that employers will offer, typically between $50,000 to $100,000. But then a lot of times employers will offer multiples based off of your salary. What I just said there is very important, though: multiples based off of your salary. So if you, for example, receive $200,000 a year of income, but then you also receive $50,000 of bonus, cash bonus, and then an additional $50,000 of stock options, there's a high probability that the life insurance coverage will only cover the salary that you have. So if you're expecting a 10x of your income, it's not necessarily the case. It's 10x of your salary. So you have to be very close or very cognizant whenever you're going through your insurance-based planning. Now, inside of that too, all of these insurance, whenever an employer provides it, they give it off of what's called a standard rate. Insurance companies have rating classes, can be anywhere from preferred best all the way to standard, and then they'll have table ratings in addition to that. There's multiple different rating classes. Some carriers can have up to 17 different, 20 different rating classes, for example. And the life insurance, disability, AD&D, and all the other ones that the employers provide is at the middle rate. That's at the standard rate. So a lot of times what we see is it actually is potentially more cost effective for you to pursue a 10x salary insurance, life insurance plan, for example, on your own dime or through your own provider, more cost effective than to have your employer provide it because of the standard rating. Now, of course, that depends on health. You'd have to go through underwriting. There's lots of different things there to be said, more than just that. It's more nuanced than that. But just as a note, that's one of the things in the financial planning process that we take a lot of consideration with. And that's specifically why. Disability insurance is a big one. Remember, I said earlier, two financial plans depend on two things, you being alive and you being able to earn income. Disability insurance is the big one. A lot of times what we see most for executives or employees is that they're missing out on the supplemental plans that the employer probably offers, where they'll offer a percentage based off of your salary. Let's say that same example, $200,000 a year of income, 50 and 50, $50,000 cash bonus, $50,000 stock. You get disabled, your employer plan will only cover 50% of your salary. So now you just went from making $300,000 a year down to $100,000 a year. So it's a drastic difference in income that we should absolutely have a discussion about if you need to make up some ground there with personally owned policies or supplemental policies that the employer offers. Accidental death and dismemberment is something that we see frequently. There's a lot of confusion around it where I think people sometimes think that is life insurance. It's very different than life insurance. The definitions are a little bit more stringent. It will provide additional benefit if somebody is killed in the form of an accident or there's dismemberment, bodily dismemberment, whatever, from that accident as well. The accidental death and dismemberment will cover some additional, but it is not by definition life insurance. So it's more specific types of coverage. There's more exclusions, more definitions that go in to the actual payments. So you'll notice that your premiums are significantly cheaper. They're significantly less than what you would get in a traditional life insurance plan. And the confusion that we see, again, is that people think that they're one and the same. You may think you're paying $2 a month for life insurance. I can almost every time make the statement that it is not. That's probably accidental death and dismemberment. It's that inexpensive. Critical illness, accidental insurance, and hospital indemnity. They're all different in terms of definitions, but do provide similar benefits and that they're catch-ups to some of your insurance plans. An example would be hospital indemnity or critical illness. If you're hospitalized or you need to go to a facility, both of those insurance types will true you up to a certain level before your other health insurance kicks in.
Is it taxable, Arthur?
For the benefit,
these are tax-free benefits.
These are tax-free benefits. That's correct. So just to answer your question directly, yes, in most cases, there is some nuance where it is not, specifically to life insurance, where we would need to have more of a discussion about. But in the vast majority of cases, it is a tax-free benefit. And why that's important is hospital indemnity. If we know that we're going to be in the hospital for an extended period of time, we need some extra cash flow in order to cover that because we're not working anymore. We don't have the same income coming in, and our disability insurance probably won't cover it. Hospital indemnity, that's exactly what it's for. Is that supplemental to bridge the gap before your other insurances start to kick in. Pet insurances, I know that's at the bottom of the list. We don't see those very frequently, but there are some pretty large pet insurance providers out there. Nationwide is a popular one, believe it or not. There's another company called Banfield that provides pet insurance. The employer sometimes will offer them, but it's more frequent that people go outside and get their own pet insurance, and it covers exactly what it sounds like. covers any needs within your pets, surgeries, healthcare issues, problems, things like that. That's all that I have for employer offered insurance options. We can go ahead and go to the next.
Yeah, and this one is kind of like the catch-all, and oftentimes presented as such in your employee benefits guide, the open enrollment guide that goes out. There's usually like a section for like ancillary benefits, or the kind of the leftover things, fringe benefits. It's super important that you understand those benefits, though, like paid or unpaid leave, what days your company recognizes as a holiday. All of those types of things should be expressed within policies, or handbooks and things that are available to you. And it's worth understanding those, because sometimes your paid leave program, sometimes you're capped at how many days or hours you can have in the hopper to utilize. So sometimes you lose vacation or sick time if you don't use it. So I always, stress that people check their sick time and vacation time balances around open enrollment, just to determine, am I on the verge of missing anything? Some employers are good about talking to you about it, but I always recommend checking it out. The other piece is tuition assistance, or student debt relief. There are tax benefits to employers. And actually, maybe you should take this back to them. I believe this year it's $5,000, but there are tax benefits to an employer when they pay your tuition. It is not taxable to you, and it's not taxable to the employer. And so oftentimes when you have the ability to go get further education, credentials, designations, whatever, there may be a way to have the employer help you out with it, but it'd be a very tax-friendly way of funding, tuition. Other pieces, just student debt relief. Sometimes employers will have, organized, and a lot of times this is usually like per offer or setup, kind of in your employment arrangement. But setting up something that has to do with student debt payoff. I've seen that with maybe jobs or positions that have a subject matter expertise that the organization was really interested in securing and retaining that talent. Maybe they knew they would need to go to college or university for their education to kind of make sure that they were a fit. Seeing that be provided as well. So look for those types of benefits. Wellness programs. I'm going to wrap that up in with mental health and wellness programs. There's tons and tons of different benefits that have been rolling out as of late. Things like services called like Hinge, right, Arthur, Hinge Health. There's all types of these services where basically they'll even send you like a tablet to track your calories and your exercise and all types of stuff. Like there's all types of wellness programs out there that are meant to promote physical activity, healthy eating, preventative care, and oftentimes it's just wrapped up in your healthcare plan that you're part of. So highly recommend that you take advantage of that. Like your MyFitnessPal subscription, maybe maybe your employer has a plan that actually covers the cost of that. Like you should check that type of stuff out. Adoption assistance, financial wellness, other employee assistance programs. Arthur, did I miss it? Did you mention the financial planning support, the fees for? Cool. I'm going to steal that thunder. So for this section, I would consider this to be more special purpose. Like not every employer has these things, but I'd highly recommend that you look into determining if they do, if you need it. So they oftentimes will have adoption assistance, whether it's financial, whether it's emotional, whether it's guidance. They have all types of resources sometimes for adoption or family building. Same thing for financial wellness, financial planning. There are some employers out there, and we have clients with these companies that will reimburse their employer, whether it's executive, director. I've seen it at manager level. Like oftentimes it's kind of reserved for manager above, but they will pay for the financial planning fees incurred for you to go about getting to get a fee-based plan put together. So we see stuff like that. That's really cool. But financial planning and that comprehensive process aside, you should also just look to see if your employer has any type of finance, basics, or maybe they offer some sort of coverage or subscription for tools like You Need a Budget or Every Dollar or Mint Capital. I'm not a huge fan of some of those tools, but they're helpful if you need a place to start. So financial wellness, financial literacy, also look at what resources they have there. And then last but not least, and I would say it's probably the most commonly, I'm always recommending people use this always. Other employee assistance programs, the biggest one is legal assistance. There are prepaid legal plans that get wrapped up into total rewards packages and benefits packages that will help pay for, litigation. They'll help pay for estate planning. So sometimes they'll cover the cost of, last will and testament, power of attorney, advanced care directives, like all types of documents that you need. They'll help, protect you in the event of liability suit. I mean, there's so many different, kind of use cases for some of these things that the best thing you can do, get your employee benefits guide, and we will help you navigate it as well. I throw that disclosure out there, but the best thing you can do is get your employee benefits guide, read it, because it was put together for a reason. It has a lot of really good information out there that is specific to your benefits and your plan, because you may have things like that will take care of legal assistance or family building, financial literacy, blah blah blah. So that is kind of this section here. That's typically what we see as the ancillary or the add-ons that some employers take it upon themselves to add to their total rewards package. So and I think the last page, Arthur, is tips, actually, right?
Yeah. So first tip, be prepared and take your time, which also goes into know the deadlines. There's different deadlines for employer-sponsored healthcare, for Medicare, and then the Affordable Care Act plans. You have to make sure that you pay close attention to them. Your employer also can have varying deadlines depending on what their needs are. The most common that we see is between the months of October and November, but that doesn't mean that that's everybody. So October and November, like I mentioned, most common, but there could be some others throughout the years. If you don't get your pick out your health insurance plans or your employer-sponsored plans within that time, you have to wait for something called a qualifying event. Qualifying event could be losing coverage elsewhere, could be having a child. There's a couple of other different ones inside of that. So you have to make sure that you pay close attention to, be prepared, and take your time. A thing that we see common inside of like benefits picking is not knowing and understanding the timelines specific to having to choose the benefits. And there's some things that need to happen beforehand. An easy example would be life insurance. Life insurance, if you're going to pursue your own coverage outside of what your employer offers, typically the life insurance carrier is going to require some sort of extended underwriting, and that usually takes longer than 30 to 60 days. So you have to know that beforehand before open enrollment starts up, or else you could potentially lose some of your coverage. You really don't want to do that. Review your benefits all the way through. Stephen was talking about earlier with some of the mental health things or the hinge health, like the additional, like the things that have been added on recently. A lot of times those will also provide premium discounts or subsidies, or they'll give you, like Stephen mentioned, the free, what was it, the iPad or the tablet, where we've seen even discounts on your premiums because of your usage of them. If you walk 20,000 steps, whatever it is, then you might be able to get an additional $150 subsidy from the company, as an example. So pay close attention to and review all of those benefits. One of the most common things that I see is everything that I mentioned earlier with the confusion of salary, bonus, and stock option incomes. You got to make sure your benefits in most cases only cover that salary income, which is very, very important. So we need to make sure that you have a discussion about it. Take full advantage of the wellness programs and EAPs. Stephen stole my thunder there, but I will say that is a very, very common mistake where you have legal services that oftentimes your employer pays for, or they'll provide you discounts for, as long as you go through their systems. Could be Met Legal or whatever the other ones are. You just have to go through that, and you have to be paying for the EAP plan throughout the year in order to use it. I almost always say opt into the EAP. It costs you $8 or whatever it is. It's very inexpensive, and you might need it throughout the year to have discounted legal services or whatever. It doesn't really make sense to not have it. Maximize employer retirement benefits, maximize special purpose healthcare benefits account, both healthcare accounts, both of those added together. Contribution limits change every year. Make sure you know the increase of contribution limits. And we're also adhering our contribution limits to that if there has been an increase. At the age of 50 and 55, there's also catch-up contributions that you have to opt into. Something I see that's common as well is with matching contributions from employers. In order to qualify in most cases for the matching contributions, you have to make contributions yourself. So we got to make sure you're making contributions or you're leaving that money on the table, and we shouldn't do that.
Arthur, can I add something real quick? I
Sure.
missed this earlier, but also think it's really, really important to mention. I glossed over this, and it's usually what most people want to hear about. Yeah, regarding the investments on the inside of your retirement accounts, your 401ks, your deferred compensation, you should absolutely be using the resources that are available to you, whether your plan is with Fidelity Net Benefits, whether it's with Vanguard, whether it's with Capital Group, any of the Empower, any of the big providers, record keepers out there. They all have investment risk tolerance calculators. They all have time horizon things. Now, from a planning perspective, their tools usually don't really have the detail in there for me to use that and say, okay, I'm on track for retirement. But they do have all the information you need to properly understand and evaluate the investment options available to you. And a lot of times they also have like their own little on-demand educational videos on what is retirement savings and why does compound interest matter and some of those things. They also have a 1-800 number most of the time where you can call and you can get some investment guidance. If you are not working with a fiduciary enforced financial planner or advisor, if you don't have a fiduciary relationship with that advisor and they are not your advisor on that 401k, really aren't supposed to be giving you holdings advice on those types of accounts just because of the way the regulation and all those things work. So if you have a fee-based planner and that type of relationship, or you have a self-directed brokerage account on your 401k, which I highly, highly recommend everybody look to see if you have a self-directed brokerage account. And if you do, we should talk about that ASAP because those are newer kind of to the field for some of those things. But you should use the resources available to really understand the investment options available to you. And then Arthur, do you want to mention investments in HSAs too? Because I totally forgot about that earlier.
Yeah. So HSAs a lot of time will mirror or close to mirror what your 401k offers, where they'll have typically once you receive a certain balance, usually it's between $2,000 to $2,500. So if you have an excess of $2,500 inside of your HSA, for example, in most scenarios, you can invest that, get that in mutual funds, similar to like what your 401k is, which you don't want too much cash sitting on the sidelines, just like you wouldn't inside of your 401k. So the same rules apply. You would absolutely want to get that money invested. It's very important. And now that same thing happens whenever you retire. You can roll that HSA, and when you roll that HSA, you have to keep it invested. Have to keep the funds in there.
Yeah. And I guess the last one is knowing the deadlines and knowing Arthur, you already kind of mentioned that of just you got to catch it with them in that open enrollment window, or you got to have a life event. I would tell everyone that is on this call, the best advice that I can give you is when open enrollment comes around, contact us, contact an advisor, contact somebody that you trust who is knowledgeable on these things to review it with you, because navigating this stuff is becoming really difficult for everyone to
Mhm.
navigate. There used to be a time, Arthur, where you and I, could kind of direct somebody, for some of these things, just kind of with the basic questions, they'd ask, well, those are the only things available in the field at the time. Like there were only a couple of options. Now there's so many things out there that if you're not looking at your open enrollment benefits guide, like if you're not looking at your benefits guide, there's no way all the options because there's so many different things out there nowadays.
So many things, and then company changes, company dynamics change so frequently. And as always, everybody knows you can contact us. You would have received the quarterly review link that would have come out in the beginning of October. You also received, if you have seen the Vita Vitals come through, that contains a scheduling link as well and has certain topics that that month would need to cover. October was open enrollment. You can always schedule from that link to get some time and we can have a discussion about it. You'll see another one coming up in November as well. So contact us if you have any questions. With that, James, that's the end. That's everything. We appreciate everybody's everybody coming in and listening to us talk at you for a couple of minutes. But with that, I appreciate everybody's time.